Hello everyone, this is Paul from the APNacademy, and in today's video we are going to be looking at what the 95% of traders ignore. We're going to be looking at what is making most of the traders inconsistent, and this is not something very difficult or something that maybe is a very hidden secret from you. No, it's not something that is very difficult to come across. And after today's video, I would just like you guys to go back to your charts. Today is a weekend. I'm making this video on the weekend. Go back to your charts and do practice of the things we're going to be looking at in this video. And you realize that actually you knew everything that was supposed to make you profitable, but you're just ignoring something very small. Now, this something small bases on just two aspects, and I've written them here as you're seeing on your screen. The first one is how we mark our areas of interest, or what we call areas of entry, and how we treat them. Most of us are marking these areas of interest correctly. That is a tick. Then this takes us to number two, areas of entry. It can be areas of entry or areas of interest. And just to go back a bit to number one, area of interest, we mark it in our bigger time frames. And then area of entry, we are marking it in our smaller entries. Now, these time frames do differ, like we talked about in the video which we made on time frames. Now, some people do analysis in H4, take their entries in minute time frames. Some people do their analysis in daily and take their entries in hourly time frames. Some people do their analysis in weekly and take their entry in hourly time frame. So it depends on how you treat your analysis, but we did a very comprehensive video on how to use time frames. If you've not watched it, make sure you go and watch it. It's one of the key reasons why people are losing money. So this is for point number one. And the second point, how we're going to use point number one, is after marking your area, is you need to watch how price approaches the area that you've marked. Now, most people do not pay attention to that. Guys, let me just repeat that. This is the key area where we're going to focus. This number two here. Let me just repeat that. The first one is you're going to mark your areas of interest or area of entry as usual. It doesn't matter whether you're using support and resistance or you're using what we call order blocks. Some of you are using smart money concept, whatever method of trading you're using, demand and supply. But according to me, they are the same. People are just playing around with terms and all that. These are just the same ideas, right? Demand and supply is the same as resistance and support, just difference in names or the terms being used. Now, the first point, the first thing you're going to do is to identify your order block, to identify your support and resistance, whatever you call it. Then the most important thing, the reason as to why we're making this video, is number two. Watch how price approaches that area that you've marked. Are we together? Now, it's going to differ what you're going to use that area for. The area that you've marked, have you marked it in a bigger time frame? If you've marked it in a bigger time frame, it's not for taking an entry. And if you've marked that area in the smaller time frame, it's for taking entry, but not for doing analysis. I'd like you guys to put that in your mind. If you mark an area in a bigger time frame, let's say daily, you cannot use that area to take an entry. That area is just telling you, hey, price has approached this area. What next? We need to look for whatever rules that we use to take trades, but not necessarily that when price reaches that area, you're supposed to take a trade. That's another area that traders are going wrong. After marking the area in whatever time frame they've used, they don't consider whether this is the time frame for entry or this is the time frame for analysis. They just, after the price has reached that area, they just want to take trades. That is very wrong. Now, why am I saying that we're focusing so much on this? Let me just give you a practical example here. If I've marked my resistance, this is my resistance, and this is my support. What most of the traders are doing is when price is moving up and approaches this area here, what most traders are looking for, it doesn't matter. What they want is, I've drawn, this is a major support or this is a major resistance. Price can't break it. That's how you're using it. Because you've drawn it in daily, you think price cannot break it or it cannot be manipulated because you've drawn it in a bigger time frame. No, that is not true. Rather, what most of you are doing is, when price approaches here, you're just waiting for an engulfing. Now, when you see an engulfing in a bigger time frame, most of you have this say that this engulfing is in a bigger time frame, it's not going to be taken out. That is not true. And you're going to lose money with that reasoning, right? But how are you supposed to treat this area? You're supposed to watch how price approaches it. Are we together? Let's take an example at a runner, an athlete. When athlete is starting to run, some of them start with a slow pace, They start with a slow pace and then go on increasing as the marathon goes on. We together. Then along the way, they weaken a bit, they lose energy, or some of them maintain the pace so that they can finish at a high pace. Now, the same applies in the market. When the price is approaching a key level that is going to make it bounce off or that is going to hold it, usually it communicates to you using candlesticks. Most of us don't understand the use of candlesticks. We're using these candlesticks the wrong way. We're just looking at the names. This is an engulfing. We crammed the names and the uses that were given to us. Morning star is for this. Evening star is for this. Bullish engulfing for this. Bearish engulfing for this. Do not use candlesticks like that. That comes after this process that I'm going to show you. For example, if this is my resistance, I need to see how price is approaching this resistance. For example, if price was coming at a very high speed, look at the size of the candles. Look at how strong the candles are, right? If these candles are coming at a very high speed to this level here, do not interest yourself with that area yet. You should only interest yourself with this area, this resistance, if price comes with a high speed and then starts losing that speed by showing you that it's decelerating. Let me repeat that. Let's use now this time support. If I mark my support, if this is my resistance and this is my support, if price is approaching my support, I'm not only going to consider a candlestick pattern in order to take a trade. No matter the time frame I'm in. After marking my support and resistance areas, I would like to see how the candlesticks are coming in. Are we following? The candlestick speed should show me that it's this area is a strong area or it's going to hold. How do I know that? I know it from the speed that the market is coming down with. If the speed of this market is very high, the candles are very big, that shows that the sellers are strong. The pace or the speed or the momentum of the sellers is very high or very strong. So I'm not going to interest myself with that area until sellers show me that they are no longer having energy or they no longer have enough liquidity to continue pushing the price down. That is how you are supposed to trade, guys. Are we together? This is just theory. Stick around. We are going to look at the examples on the chart and what I do mean by this. If you guys implement this, you are going to realize that you actually were doing the right thing, but missing out just a small aspect of this thing that we're explaining. Are we following? One, mark your areas of interest. Then matter whether using demand and supply concept or ICT or order block or resistance support. And then just watch how price approaches that area that you've marked. Are we following? Watch how price approaches. Some of us tend to panic. We tend to rush. Since price has reached here, let me go and look for M's and W's. That's why you guys see M's, you see head and shoulders, you see structure, you see patterns, and are not respected. They're not respected because price has not lost its energy of going into that direction. If price was going up, you've rushed before it loses the energy to continue going up. For you're rushing to sell in a market that is strongly moving up, or you're rushing to buy in a market that is still strongly going down. Are we following, guys? Are we following? Hope we're following. In case you're not following or you're lost somewhere, please do not forget to put your comments down below. I'll be able to respond to you guys, right? So now let's try to go into the charts and see exactly what I'm trying to mean and how you can try to put this concept into implementation. Okay, so I am on my chart, and in today's example or today's video, I'm also using a MetaTrader 5 because I would like to show you guys that all the platforms for doing your analysis can be used as long as you're comfortable with it. Do not only focus because most people are using TradingView. You also struggle to use TradingView. If you're not comfortable with it, you can use MetaTrader. And today also we're using example on synthetic indices market. Remember, I told you guys that whatever we are studying works on every market that you're trading, whether you're trading commodities, whether you're trading synthetic indices, whether you're trading the stock indices, whether you're trading currencies, it works everywhere. So in the series of videos we shall be giving examples on all these types of markets to show you that what we are learning, you can use it to trade anything. right? So let's take an example on V50 and I show you what I'm trying to mean. Now, let's start with here. Of course, remember we say that how to mark support and resistance, just turning points. For example, the market came up. Let me just show you. The market came up, right? And turned from here. So this becomes, and turned from here to come down. So this becomes, this area here becomes a very key point in the market, this turning point here. So I'm going to come and mark this area here, right? So when I mark this area here, what happened? I just want you guys to see here like this. Now, what most traders do and why people are losing money. Let me just show you an example here. Since the price came down here, right? And price is now coming up. I want you to see how the price is up, these candles that are approaching. Now, most people are going to come and want to get what we call sniper entries here in a bullish market. Look at the momentum. This candle is small. It got bigger even because the sellers tried to come in and they rejected and got bigger. Now, most people are going to come here and just start taking sales. Because we're in weekly, they'll go to smaller time frames and get engulfings, get evening stars, and that's how you lose money. But just check out the market is moving. The market is actually gaining more power to go up. The market showed you that buyers are in control. Sellers tried to come in, but they're overpowered by buyers. Look at this candle here, smaller than this next one. The next candle was even a rejecting one and a big body. So this shows that buyers are in control. You don't need to take sales in this area. It means that you'll be selling in a market that is buying, right? That is one. Now let's continue. Then two, the market came and broke above. Now I just want you guys to see how the market came into this area here when it was retesting. This is what we call a break and retest, right? So what happened? The market came, gave you a sell candle, which was big, this sell candle here. But look at the next candle. Look at the next, it was small, right? This is communicating to you that sellers can no longer continue down because the candle is small. It is communicating that I am not energetic enough. I do not have the resources to continue pushing the market down. And this is confluencing with your previous resistance. Recall, we say that when resistance is broken, it becomes support. So here, this was a resistance, which was broken here. So it became support. Now, when you see this, this is a communication to you that there's a possibility the market is going to reverse because of the size. That's just one aspect. The next aspect you're supposed to look at is how do the buyers react? Do the buyers show us energy of coming to the market? When that has been satisfied, and then you go into your entry time frames to take or to look for patterns, if you're a pattern trader, to look for shapes, if you trade using shapes, whatever you use to take your trades. Are we following? Now, that is one example. Let's use this same chart. Let's continue while using this same chart. Now, the same applies here. Let's just use this example here. Now, the market created this turning point here. Let's just mark this turning point here. Do you see this turning point? This turning point here. This. Now, look at this. Look at this, guys. The market came up, how it was approaching, but the momentum was bullish, of course. Sellers tried to come in, but they were broken, right? Of course, we know that when a resistance is broken, this is a turning point, so making it a resistance. When the market broke it, look at the momentum. Buyers are strong. So the market just came to retest this area here. But look at the candle that came to this. This is a very big buy candle, meaning that it's a strong, it's showing you that the buyers are strong in the market, right? So there's no reason for you to come and start taking your sales from here. Unless you say that, unless you're trading or you're doing intraday and you just want to trade a retest to this area here. But if you want to trade in a safe market and flow with the trend, you cannot start taking trades whereby the momentum is still strong towards the direction that is against the trade that you would like to take. If you want to take a sell, you cannot take a sell in a market whereby the momentum is still strong. For example, look at the candle that was approaching the resistance area. The candle was still very, very strong. And the next one closed above it. Look at the momentum continued going up, right? Now also look at the retesting momentum. The testing momentum was not strong enough. Sellers tried to come in and buyers rejected them, right? Now, such market conditions, you should not trade in them. We need to see a market that is communicating to us. The market needs to communicate to us, right? So the first situation here, there was no opportunity for us to take trades. But I would like you guys to see on this next opportunity here. Look at this next movement of the market here. The market came down. There's a huge rejection. Of course, this is a turning point. Someone could take a trade here, of course. This is a turning point. And then look at how the market approached this turning point. Let me just delete this. A big candle rejecting, but the next candle was small. This is showing you that this resistance could hold, right? So you can easily go to your entry timeframes, or where you look for change of trend timeframes, and then you start observing the rules that you consider when taking trades. Look at also how the market came back. The market came back and was rejected with a big candle. And you could also take this trade because we're in a bigger time frame. I don't know if you guys are getting the concept. If you're not getting the concept, please just put your comment below and I'll be able to answer you. Now, again, just look at the same thing that happened. It happens over and over, guys. If you guys can master this, you will avoid false breakouts. You will avoid losing money unnecessarily. Now, look at here. The market was rejected. Of course, we know our next target is this previous resistance, which became support here. So the market made a big candle. It reduced and then it became even smaller. And then buyers came and took control or made their presence significant by showing you that we have energy in the market. So whenever you see this happening in the market, big candle of sellers, it shows that their momentum. But the moment it starts reducing, for example, plus even when it touched the area, it rejected, right? So this is telling you that sellers, we no longer have energy to go into the market or to be anymore in the market, right? So, and also the next one, remember we said the first one is that loss of momentum. The current trader is showing you that we can no longer continue. Then the next one is let's say if these are sellers in the market. The next one is buyers communicating that our presence is there, right? This one here. Then you can go into your smaller time frames and take your trades. You can clearly see the market made a retest. If you go to a smaller time frame, this is a retest, and then pushed up until your next resistance. This is how you use these levels and how you use momentum into your advantage. Are we together? Are we together, guys? This is in a bigger time frame. Let's try to go and use the smaller time frame. Let's try to go and use the smaller time frame. Let me just delete this. Let's just delete these objects, and then we try to use a smaller time frame. Let's say an entry time frame. Let's use, let's say, H4. Let's use a different instrument. Let me use V75 for this example. Now, for example, the market broke this turning point here, which made it become a support, right? This area, this was a turning point. The market went up, and then came back down, right? Now, and finally, it broke above this area, and you can clearly see the momentum it used to break, right? So the area became support, and the market tried to retest it here, you can see. So the market kept going up, up, up. But I just want you guys to see how the market approached this area here. Remember a previous resistance, when it's broken, it becomes support, right? The market was showing you that the sellers are into control. Look at the candles coming back. Check how it started losing momentum, right? So now someone is going to just jump into the trade here and say that I'm supposed to buy. Yes, the momentum is there, but we do not have the next aspect that we have spoken about. One, we need momentum change into your area of interest or area of entry. In this case, it's our area of entry. Then two, we need presence of the direction that you want to take. For example, I want to take a buy here in this area, but I need buyers to show me that their presence is available into the market. Yes, I'm having a loss of momentum, which I've been given by these candles. These are big sellers. Sellers are showing that they're strong in the market. They started reducing. That is one. But I need also the second aspect, which I've not been given. I need buyers to show me their presence into the market before I can take my trade. Are we following, guys? Without these aspects, you're always going to lose money, or you're always going to want to get sniper entries and you'll keep losing money. Or sometimes you'll get lucky, make money this time around, and you don't know because you don't note down the reasons why you've taken the trade into your journals and all that. You don't know why you've won that trade, or so you just have won it by luck. So to avoid that, make sure you put these aspects into consideration. Are we together? So I showed you guys an example in a bigger time frame, and I've showed you an example in a smaller time frame. This is H4. Personally, I use H4 to take my trades. And both the time frames have different uses. The bigger time frame, we use it just to identify area of interest. And then the smaller one, we're using it to take entry. Now here, this is an entry time frame, and this is an area whereby I would take a trade from, but I don't have a second aspect, of course, plus other rules that I should use to be taking my trade. So before your rules, whatever rule you use to take trades comes into play, this is the first thing you should consider: momentum change. We need to see traders of that direction that the market is flowing in losing interest or losing energy, right? They have to first communicate to you that we are tired. We are no longer energetic to push the price down or up. Then your rules can come into play. What have I seen? Do I trade using patterns? Do I do what? Where do I refine my trade from and all that? Without these things, you'll always face false breakouts, take bad trades, early entries, late entries. That's how these things result. The first thing is momentum loss, or what I call change in speed, reducing speed for a layman to understand, right? So if you found value in what I've spoken, try to implement it. You'll see the importance of this thing, and your accuracy is going to really go up rapidly. If you found value in what I've put across in this video, do not forget to smash that thumbs up button. And if you're new, you've just come across the channel, do not forget to subscribe to the channel so that you get many more videos of such kind. Have a great time.